Okay, hi everyone. We are team 8 from the FCSI group, and we'll be taking you through our mini project, which is predicting stock market trends using machine learning techniques. I'm Alok, and this is my team member Yash. Okay. To start off with, this is our table of contents. Coming to the first part, what is our problem statement and aim? So our problem statement is how can we leverage machine learning models to predict general trends in Nasdaq stock prices. We focus on capturing the broader market dynamics rather than the exact future prices to inform and guide strategic investment decisions with risk mitigation. Why trends and not exact stock prices? Well, predicting exact stock prices is highly susceptible to the volatility and unpredictability of the markets, which is influenced by countless unpredictable factors. We simply can't predict exact prices. By focusing on trends instead, we seek to understand the underlying patterns that drive market behavior over time. This provides a robust, risk-free framework for investment strategies that can adapt to market changes and uncertainties. Coming to data acquisition, so a source for our data set was Yahoo Finance. The content it contained daily trading information such as open, high, low, close prices, and total volume. So the data set spanned over the last 5 years, which provided us with a substantial frame. Coming to data preparation, so firstly we had to handle the dates. We converted the date column to a date time format and set it as the index of the data frame. You can see it in the snippet below. Then we calculated various technical indicators such as a simple moving average, estimated moving average, and MACD, which we'll explain later on. We had also had to handle missing values, and we had to ensure whether the technical indicators had no missing values. We use the function given below to uh, specifically specifically for moving averages to handle any missing data points. So this is a glossary which you can come back to any time if you we could not explain all these variables in the interest of time. So this is the statistical description of our data set, and these are the insights we've gained. So the trading range, the prices have a very wide range as indicated by the standard deviation. There's a significant difference between the minimum and maximum values that suggest periods of high volatility. The average trading volume is very high, and the standard deviation indicates fluctuating trading activity. The maximum volume is much higher than the average, pointing to days of exceptionally high activity, which may align with the market events or announcements. Coming to the price stability, the median is not very far from the mean, which tells us that the data is symmetrically distributed around the mean. So this is a basic time series plot of closing prices. It shows the stock prices over time, over a period of 5 years, and it helps us visualize trends and seasonality. This is a rolling standard deviation graph, and the rolling standard deviation is a measure of how much prices deviate from the average price over the past 20 days. This provides a dynamic measure of volatility. We also had a histogram, and a histogram suggests a moderately volatile market with returns that clustered around zero. This indicated significant daily gains or uh, this indicated significant daily gains or losses were not exceedingly common. Now we had a correlation matrix of the close prices, and we can see a very high positive correlation between the closing price and both the moving averages, so SMA and EMA. Coming to the simple moving average, so converging crossovers between the two SMAs might be used to predict future movements. A golden cross pattern could predict upcoming momentum, and a death cross could prevent downwards momentum. Coming to the EMAs, so estimated moving averages, the characteristic behavior between these two EMAs could be taken as a signal. So a bearish one, we could take it as a bearish signal if there is a crossover between them. Coming to the MACD, so when the MACD on the chart crosses above the signal line, it's often seen as a bullish signal. So it's a good time to buy. On the other hand, if the indicator MACD crosses with the signal line, it might be taken as a bearish signal and it's time to liquidate your positions. Now we have the augmented Dickey-Fuller test, which is the ADF test. It's a statistical test used to determine whether a time series is non-stationary. Non-stationarity in a time series means that the statistical properties of the data, such as the mean or the variance, change over time. Coming to the seasonal decomposition, seasonal decomposition of closed prices is a method used to separate a time series into its trend, seasonal, and residual. So the trends represent a long-term movement and tells us whether the data is generally moving upwards or downwards. So the general trend. Seasonality unveils repeating short-term cycles within the data, and residuals captures the noise or the randomness in the data which could not be put into the seasonal or the trend. So we have a candlestick chart as well, and each candlestick describes one day's worth of trading into a candle that contains the day's opening, closing, high and low prices. For example, and it also contains various patterns. So a long body would mean immense buying or selling pressure. There are also continuation patterns, and other patterns such as a series of identically colored bodies may suggest a continuation of the current trend. Now we have Bollinger Bands, which indicate market volatility. So a wide band suggests high volatility, and a narrow band width indicates low volatility. It also indicates the trend and through the middle band. So if the middle band is sloping upwards, then there is an upwards trend, and vice versa. Coming to machine learning, so we implemented three models, namely LSTM, SVR, and isolation forest. Coming to the first model, so why this model? So basically, the stock market, as we know, is very volatile and non-linear. So LSTM networks can capture these complexities. The real-world validation is evident as many financial analysts and traders in the real world use LSTMs correctly. So this is evidence that it actually is very effective in predicting stock market data. So data preparation. Firstly, we use the min-max scaler to collect all the technical indicators and convert them into something that could be used by the LSTM model. So the function given below, create multivariate dataset, takes in the scaled features, these technical indicators, collects them into sequences, and then converts them into the input X and the input target Y, which represents the close price later. This can be used by the LSTM model. Model construction. We have this model using the Keras sequential API. We've set it up with two layers of LSTM. So the first layer uses return sequences to pass on its output to the next layer. Then we have a dense layer to generate the final predicted value. For training, we're using the ADAM optimizer, and a mean squared error is our loss function, which is minimized by the model. These are pretty standard for regression problems. Now we train the model on a data set for a certain number of epochs. In our case, it was 10, as you can see, and our batch size was 1. Coming to the SVR model, so why did we choose this model? The SVR model has a regularization parameter which helps prevent overfitting. This is vital in the stock market. And it is also very robust to outliers. So it is less sensitive to outliers when compared to other regression methods. This is very crucial in financial data sets where there are a lot of anomalies and they are pretty unpredictable. So data prediction, we scaled the data the same way. We just used the standard scaler this time. The same technical indicators were scaled. Model prediction, so we split the data into 80% training and 20% test data set. We trained it with the RBF kernel, which is a radial basis function kernel. It's pretty popular for stock price prediction due to its ability to handle non-linear relationship between features. Thirdly is isolation forest. So we use the isolation forest for anomaly detection in the stock price data. So we won't go into much depth, but it has a low linear time complexity and it performs very well in large data sets and data sets which is with a lot of noise, which essentially represents financial data sets. Now coming to our results of the so these are the red points which are the anomalies in flagged by the isolation forest model. So coming to our predictions, we can see in both models, we can see times where they very closely mirror the actual returns, but there are also times where there's a noticeable difference between what's predicted and what actually happens. And coming to the second figure, the price distribution curve from the LSTM model looks closer to the actual prices, while the SVR model diverges further, showing something quite different from the actual price distribution. All three lines show an upward trend in the third model and suggest that prices are generally increasing over time. Both models capture this trend to different extents with varying degrees of accuracy. The correlation values between the LSTM and SVR predictions and the actual prices are very high. LSTM is at 0.9 and SVR is at 0.98. Sorry, LSTM is at 0.99 and SVR is at 0.98. This suggests that both the models are pretty effective. So these are actual prices versus predicted prices. So coming to a conclusion, we successfully demonstrated the effectiveness of machine learning, particularly to the implementation of LSTM and SVR models. Our approach emphasizes trend recognition, offering investors a strategic decision-making tool. And I would like to highlight the superior performance of LSTM, and it closely aligned with the actual market movements. So LSTM is more effective than the SVR model in trend prediction. Thank you.